You're hearing everyone tell you that the SP 500 is the safest, smartest place to invest. But here's the problem. It's massively overvalued, it's not diversified as we thought, and it could actually delay your own financial freedom. So let's dive in. What are those hidden risks that people aren't talking about that you need to know? Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you if you want to become work optional, where you have enough passive income coming in to work because you want to, not because you have to. You want your money working harder for you, so you don't have to work so hard for that money. But you're not just doing it to get rich. You want to live a rich life because as you grow your wealth, as you become more financially prosperous, and you cover your own family's needs, you then also want to create a ripple effect through the lives of others by blessing their lives. And that's exactly what I'm here to do today. Thank you for tuning in and binging on our show. Again, we're almost to 1,000 episodes total over the last 11 and a half years. This is all because of you. Thank you for tuning in. If you guys thought this was a great episode, please like, subscribe, but also feel free to share this with your friends too, because this message is so important. And we want 1,000 of you families financially independent by the year 2030. If that could be you, if you want it to be you, go check out our passive income calculator at moneyripples.com. Okay, so it's no surprise here that we've talked a lot about stock market. The S&P 500 obviously has been the major benchmark that most people go off of. And the thing you'll always hear, of course, is that arguably the S&P 500 is the best, safest place to be. It's diversified. It gets the better returns compared to anything. And hey, you can't argue the fact that, you could argue it, but arguably roughly about 89, 90% of mutual funds underperform the S&P 500. And they've often got more fees than the S&P 500 has as well. So the big argument is, index funds, SP 500 index funds, that's got to be the place to put your money. That's got to be the best return, right? Or is it? And this is the big problem, right? This is the big debate. I used to believe the same thing. Understand, I came from the life of being a financial advisor, first and foremost, where eventually I realized index funds were better. Two, even more so, I was a stock trader. I often traded the S&P 500 index itself. Before some of you guys even knew it existed, I was trading it. So understand that I'm coming from a standpoint here that I was all in on stocks. I was all in on indexes, loved it because I love the fact that it was diversified, right? And it did give you some extra predictability, especially if you're trying to trade things back and forth. But that being said, what's happened now in more recent days is we've had, of the last 16 years, 15 years have been up. Understand the S&P 500 has not done that for history. Like, it has not been so far up for so long without having some good correction years. This is where we are now. We only had 2022, and most people forgot about it like it didn't exist. And this is the danger we're in right now. And so I want to talk about that today. I actually want to share a nice little video from our friend Dave Ramsey, what he actually said to a caller who called him arrogant and stupid. So let's show that video right now.
Up next is going to be Chris in Los Angeles. Hi, Chris. Welcome to the Ramsey Show.
It's not me, just so you're wondering.
Hey, Dave. How are you doing?
Great, man. What's up?
There's a couple things. One, you've done some great work, and in some ways, I love you. In other ways, you're stupid and arrogant.
Okay. How can I help you?
All right.
By the way, that's a great way to start any conversation right there.
Yeah.
Sure is, right? All right, so let's get into his question, what he's actually going to ask here.
Yeah.
The point of my call is you push people into actively managed funds when over time, if you pushed people into an index fund, they would have about 50% more money when they retire.
Okay. Not sure where you went to school for your math class, but you failed.
Actually, compounding costs
I understand.
add up dramatically.
I got socks older than you. I've been teaching this a while. Okay. So this is how this works. Now,
he says that because the guy is actually 35 years old. And it's true. I think when I think back, I was investing in stocks when this guy was in grade school. Good to know.
the thing. You're basically doing what Bogle said, and Bogle invented a wonderful thing with the index fund, and the S&P 500 funds are wonderful. The index funds are wonderful. They are not a cure-all, and there's no possible scenario, unless you're an absolute idiot in picking your actively managed funds, that you would have 50% more in an index fund. Now, the actual facts are more than 50% of the funds underperform the indexes. That is a true fact, to your
Arguably a lot more than 50%.
point.
That's a different fact. The fact is 2%, 2% above, if you have a 7% return versus a 9% return, which you have the compounding cost bringing your return down by 2%, over 50 years, you'll have half the money. Do the math on that,
Well,
Google it.
That would be true too, but none of those numbers you're using are accurate in terms of what the S&P has produced or what actively managed funds have produced. The actively managed funds that I personally have picked have outperformed the indexes by more than 2% as a portfolio, because it's fairly easy to study mutual funds and pick them that outperform. But if you're not going to study them and you're not going to have a good advisor in your corner, then using the index funds is a great idea. Here's what we actually found in the real world.
Okay, so right here, I'm actually agreeing with Ramsey. I think he's making a great point. If people don't know what they're doing, because the truth is, we already know mutual funds don't do well. But of course, if you're dealing with most people who aren't going to do the homework, as he's saying, yes, index funds could be a better deal, right? But just so you know, hang in here, because at the end of this, I'm going to talk about something that could be better than even the S&P 500, proving to this point of the caller and also Dave Ramsey's point too. I'm going to skip past, by the way, this little section about he talks about his 10,000 millionaires, because it's kind of interesting, but not that interesting.
Almost all of them did it with their 401k with actively managed funds. Now, some of the funds actually underperformed the S&P, and some of them overperformed the S&P, and some of them used an S&P because a good 500 fund was in their portfolio as well. Now, let's go back to Warren Buffett for just a second. Are you aware that Warren Buffett does not have all of his investments in index funds?
Mm-hmm.
Of course.
Okay,
he has
good.
it in a holding company.
I'm not sure, other than the fact that he has stated that the average guy, because he's a Bogleite, the average guy should buy index funds instead of actively managed funds. Other than that, he doesn't actually do what he says he's going to do with that. He actually has an actively managed portfolio called Berkshire Hathaway. Are you aware of that?
Yes,
Remember this, okay? This is a good point that Dave's making, but also remember this point when we turn it back around on Dave too.
I am, and he's doing it with the money he's leaving to his wife when he dies.
Well, that's fine. I mean, where the money's going is not relevant to the mathematical discussion. The mathematical discussion, Chris, is simply this. Warren Buffett made comments frequently about the average guy should buy index funds, and I really don't have a problem with that. You can get rich with index funds. Not 50% richer. That's complete BS. But
that is true.
But you can get rich with index funds. I don't have any problem with that at all. If that makes me arrogant, fine. But I think we're confused as to who's arrogant on this call, brother. I think that's the
Okay. All right. So for those of you guys who've been following me for a while, you know it's no mystery. I've had my own disagreements with Dave Ramsey, especially when it comes to wealth building. And there's still some here, but for the most part, Dave made excellent points. So anybody who thinks I hate on Dave Ramsey 100% of the time, this is not the case. He made a great point. Here's the big point, right? Berkshire Hathaway is a professionally managed fund. Berkshire Hathaway has outperformed the S&P 500 and done better. So if everybody was saying, "Oh, I should just go with the S&P," why not go with Berkshire Hathaway? Now, to this caller, this Chris caller, to his point, right? He's trying to say that these extra fees that are associated with mutual funds are bigger than the S&P 500 index, like buying the index fund, right? Which is true. Just so you know, so you're aware, there are still fees associated to index funds, right? It may not be a sales commission fee, but there's still fees. Even if they're just minimal, they're still there. And 2%, that's true in some cases, but he's being pretty extreme here. For the most part, that's not the case, unless you've got a 401k. And 401ks do have extra 12B1 fees, administrative fees, like where they can charge lots of them. So they may not have a sales charge like a financial advisor will give you with a professionally managed fund, or they might charge you 1% to 2% if you use a financial advisor, or worse, you use a financial advisor who charges you fees and puts you in mutual funds that also charge fees. right? Which is possible. Many cases, though, a lot of times those advisors will do their own type of investing. But if they're just picking funds for you and charging you as well, now we got an issue, right? But that being said, I mean, 2%, he's going a little bit high on that to prove a point. But here's the thing, guys, like everybody keeps talking about S&P 500, is it better or not? Berkshire Hathaway has proven it's done better over time. Like it's been a much better investment than SP, especially during down times. Because Warren, like he's already been doing, has been selling off stocks. He's now in the highest cash position he's been in history, percentage-wise for portfolio and dollar amount wise. He's got over 300 billion just sitting in cash, not doing anything. Why? Because he sees the S&P 500 not being a good investment right now. Now, I've said this in another episode before about, are you really diversified? You know, if you're in the S&P 500 or if you're in, stocks or mutual funds. And the truth is, no, you're not. And more so lately, because understand this, if you look it up right now, the S&P 500, 40% of it is made up of just 10 stocks. 10 out of all the 500, 2% of stocks control 40% of the index swings up and down. So when I mentioned I traded the S&P 500 index, that's true. But back then, even though it was still weighted to the bigger companies, the bigger the company, the more it affects the price of the index, right? Well, that being said, like even then, it was way more diversified than it is today because we've got bigger and bigger companies. NVIDIA alone makes up about 8% of the index. 8%. That's 1/12 of it is from one stock out of 500. That's 1/12 of it. So if NVIDIA goes up a lot, the S&P index goes crazy, but it's not real market. It's not real economy. It's all fake. It's being tainted. But if NVIDIA crashes, even if the market is strong and that crashes, plus there's other tech companies that will follow with it that are also big movers inside the S&P, that could bring your index down. You can actually make worse returns than the actual overall economy or stock market. And that's the debate. Now, some people might say, well, what about the Woosher, the 2000, right? What if I go with that or go something there is an actual like non-weighted S&P 500 index you could use. But again, it's not really diversified because everything's in paper assets. It's all in companies, right? So yes, it's diversified among companies, but it's not diversified asset class we've talked about before. So that's a big, big risk factor that many people aren't addressing. Even the big seven, the Mag 7 makes up over a third of the S&P 500 index, just 7 companies, right? And as I mentioned, even the 10 make up a 40% of that. So we've got this big risk where now it's the least diversified it's ever been. And on top of that, what about what he was saying here, like about actively managed funds? Now, Dave argued that actively managed funds that he had actually outdone the S&P 500. And he says, well, it doesn't take a genius to figure out the market and mutual funds and everything else. So he kind of was a little bit demeaning to this guy to say, well, I've figured it out. Why can't you? Anybody who has half a brain can figure it out. Well, okay, sure. Gotcha. Thanks for noticing. But it's actually not as easy as you think. Because the problem with mutual funds, and I had the same problem as a financial advisor, was that you might get one good money manager one day, one particular year or even over several years, but then 5, 10 years later, that fund is trash, right? I saw this in the early 2000s. In the late 90s and early 2000s, Janus was all the rage. You would get the Janus funds. I remember talking about in the year 1999, one of the Janus funds did 132%, way outperformed the S&P 500 by far. Guess what? By 2010, no one was investing in Janus anymore. And I say that loosely. Obviously, there's still people investing in Janus, but it just wasn't. It wasn't like it was in his glory days, right? Money managers change in and out. And also money managers are restricted by how many trades they can actually do. Even like, for example, I watched this firsthand in 2002, especially, right? When I was a financial advisor in 2002, Enron, as some of you guys might remember, Enron went defunct. Enron had cooked their books. They lied about their numbers. They weren't profitable. They were actually bankrupt, and tons of people lost money. Enron was a big company, even within the S&P. Enron was a huge company. People had lots of money in that. I knew people personally that had their own livelihood in it because why? They worked for Enron. They had company stock. They said they were millionaires just from the stock alone. And then it came crashing down. Not only did they get laid off, but now their stock was worth trash, right? It was worth nothing. Well, guess what? Money managers couldn't even sell off Enron all at once. Unlike us, where we could be more fluid, and this is the argument for the S&P index, right? Because we can be more fluid. We can call and just sell out whenever we want. for the most part. There are times they might shut down a market to prevent you from doing that, but they can still, they still prevented money managers from pulling all their money out. So even as it was tanking fast, they couldn't sell it off fast enough. Lehman Brothers, more recently, right? You're talking about the Great Recession. Same thing. Lehman Brothers, everybody was trying to sell it off, but they couldn't do it. They had to do it in chunks because, again, those mutual fund money managers have so much under management that obviously the SEC does not want them crashing the stock market. So remember, there's these little things like this that do affect what's going on. Now, let's talk about the S&P 500. Is it the best investment? Is it the most diversified? Is it the safest bet to go? The truth is, as we already talked about, not necessarily. Now, remember too, Dave Ramsey got his professionally managed funds. Maybe he found a way to do it. But think about it this way. Many family offices, people that deal with those, have tens of millions of dollars that are actually of assets under management, where they get real advice, not the middle class or even the lower upper class that get just crap advice. You get financial advisors, while these guys get better money management. They're getting hedge funds. They're getting actual like privatized type of stuff. They're investing things like real estate, private equity, in oil and gas and different things. They're actually diversifying, where S&P 500 is not diversified. Again, hardly anybody's ever talking about the fact that the S&P 500 is just an index. And what has that index done? Let me show you. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. Here's a chart I ran just up through the end of August. I wanted to see what the 30-year performance of the S&P 500 was. Here it is, guys, 8.47%. That's the average going from August of 1995 to August of 2025. In this period of time, you can also see there's this nice little dip here, right there in the middle. That was the Great Recession, right? The global financial crisis. You saw it from 2007 and 8, really after 8 especially, saw it come down through 9, came down hard and fast, right down to this red line, which is our trend line. This is the line that long term, ever since I'm going back to the Great Depression, here's the line that the stock market tends to follow. It might stay above it. Like, I've got an arrow pointing to, right there about 1995, right there. That's where it started. This is actually going a little bit before 95 into 1990. But you see here, there's a big run in the 90s, then Y2K corrected. Didn't quite come all down all the way, but it did come down quite a bit. That was a big correction, by the way. That lost nearly half of people's money. Then it came back up right to that previous high and then right back down again. Got really lower than it did during Y2K. So if you were in the market in 2000 thinking, man, I'm so smart, then by 2009, you're thinking, I'm broke. I got to keep working. This is what happened to my dad, right? As I've shared in this many times. Now, did it recover? Yes. By 2013, it got back to where that previous high right here. Unfortunately, because of those fees, just like this Chris guy caller, this caller called in about those fees, most of the clients I talked to during this time, remember, I was a financial advisor during most of this time right here, for nearly 25 years. Now, the caller called in, he's talking about those fees. Well, yeah, those fees made it to where it took till 2015 before he started to see that really work, right? And so right about here, that's when people started to actually break even on their money from 2000. Because yes, he's right. Those fees do make a difference. Now, if it's S&P 500, if that's all you invested in, which by the way, the index was a less known option. There wasn't as many people doing that or funds that are out there. Now people are doing it more often, but it wasn't popular. Like that's the thing. People talk about, oh, they've been doing it forever. No, they haven't. The traders have done it, but average savers haven't known about it till recent years. So maybe it was like 2014 or so before you made your money back. Still, it took 14 years or so before you finally broke even, right? Well, right now we're way, way higher. Look how high above this line we are. This reminds me of Y2K, where we're so far above the line, had to pull back. And then, of course, we saw that whole decade of the 2000s end up just being horrible for the stock market. And it's still, yet, even with this 16-year run up, right, with very little dips. There's that 2020 dip that popped right back up a few months later. We had 2022 with that. Actually, it's 1 year we actually had a dip, but still 15 of the last 16 years have been up, and here we are. Is that the best investment? Arguably, Maybe not, especially when Vanguard has actually come out saying they expect about a 3 to 5% average return over the next 10 years, not 10 to 15% average returns for the last 15 years, right? It's been closer to 15% average. Not quite that much, but it's close to that. That's way out of whack. That's way above. 8.47, by the way, is the highest I've seen as I've been tracking it almost on a monthly basis. Now, this does not include dividends reinvested, right? So even if you do dividends reinvested, which by the way are much lower than it used to be, because now the SP 500 is made of companies that are not big dividend paying stocks. Now they're mostly just paying based on stock price. So you might see maybe a 9% return. And that comes to my main point. Is it the best place to invest? Well, let's talk about that, right? Here's what I want to show you. All right, so I'm going to bring up this interest calculator here for you. Simple math. I'm just going to say, what if you were contributing 20,000 a year? Doesn't matter if it's going to 401ks where you might get a match or not. That's irrelevant. I've done plenty of videos on that point. But just say you are saving 20,000 a year total, which for a lot of you might be more than you're saving. Say you do that for 30 years at that 9%. So again, I'm being very generous. Most people in mutual funds, like to that Chris's point, most mutual funds don't do as well as the S&P 500. So I'm assuming that you're actually going to get S&P 500 type of returns, which for the next 30 years, 9%, I think is still a very, very generous number compared to what I've seen. Again, most time I've seen SP between 7 and 8%. You might lucky get 9%. Okay. So after 30 years, what does that mean? You have almost $3 million. Now this sounds great, right? 20,000 a year for 30 years, you have almost $3 million. Awesome. Remember though, if you're just assuming this puts you in your 60s, right? You're not supposed to pull off 4% a year. It's supposed to be 3% a year. The 4% rule, we already debunked that in another video. 4% is only true if you're going to retire in your 70s, much like you hear a lot of these guys like Ray Dalio and people like that saying you should wait till, or Peter Schiff and guys like that. No, we're talking about 60s. That calculation is right around 3%. So 3% of 3 million is about 90,000 a year. 90,000 a year doesn't sound bad, but what does that look like in 30 years with inflation, right? And remember that we haven't paid taxes yet if this is like IRA money or 401k. Well, I go off just a 4% inflation rate. I know they always try to tell you 2 or 3%. Again, we debunked this one in a previous video, but 4% is very conservative because the governments have already tampered with the numbers to make it lower. So they have to do the cost of living increase on Social Security so they don't bankrupt Social Security so quickly, right? So they've already been manipulating those numbers. I think 4% is, again, being very generous. I'm giving a generous return on the S&P and a generous return on the inflation rate. And look, even after inflation, that's 916,000. 3% of that is how much? 27,000 a year. Think about this. You save 20,000 a year to live on just over 20,000 a year. After you pay taxes, by the way, you might be left with about how much? 20,000 a year. What if you could do better? Dave Ramsey talked about the fact he has all these professionally managed funds. And yes, I guarantee he probably does. But have you ever looked up Dave Ramsey's net worth and where does he actually have his assets? Yeah, arguably, there's different people and different stuff, but I didn't go with AI. I actually looked for real sources and looked at individual sources to try to figure out what it was. Because there's a lot of people even saying he's a billionaire. And even he's been saying he's worth like $600, $700 million. Not true. He was using an overinflated real estate numbers on his real estate. Arguably, he's about $200 million of net worth, which is still incredible, right? Incredible. Where did he make that money? Number one, first and foremost, in his business. Of course, he paid his employees dirt cheap because it was a ministry, right? So he was able to get away with paying low wages for the mission. And again, I'm not about against saving costs, but we know that obviously Dave Ramsey talked about being very frugal, right? Being very cheap. He was cheap with his employees. He's had lots of aside from all the lawsuits and stuff against him for being a tyrant, in his company, right? Aside from that, because that doesn't matter, right? What does matter is that he was cheap, he was profitable in his company, he's made millions and millions of dollars. Where do he put those millions of dollars? Not in the S&P 500 index, as he just explained, right? In fact, he put it in his managed funds. But guess what? He didn't put it all in his managed funds because guess what he did? He bought free and clear real estate. So because remember, he's against getting any mortgages. So he bought free and clear real estate. Right now, of that 200 million, there's about 150 million that's his properties, his real estate. His business is worth about $52 million, depending on the day and valuation estimates, right? So $50 million for the business, 150 million for the real estate. What about all the rest? There's not much else there. So that's the interesting thing. Now, I try to look everywhere. I could not find how much he actually has in managed funds and things like that. I can guarantee you it's the minority of his portfolio. While he's telling you put all your money in like the market, whether it's S&P 500 or not, he's still saying put all your money there, but that's not what he's doing. He was taking all of his millions of profit, buying free and clear real estate, and that made up most of his wealth. And he had a profitable business making up the rest of his wealth that he has. Everything else is just gravy. The problem is you're not that kind of person. You're not the person that can be saving millions of dollars. Maybe you are. Maybe you have a business that is, but the vast majority of you listening to this right now are saying, man, 20,000 a year wouldn't be bad. I would like to save 20,000 a year. And guess what? This is what you're left with. Again, 27,000 pre-tax. If you pay taxes on that money, then you might be left with about 20,000 a year, depending on what taxes are doing. Could we do something different? What if we did something more like what Dave Ramsey said? He talks about Berkshire Hathaway and what Warren Buffett does. Why shouldn't we invest like Buffett? Good point. Well, why don't we invest like what Dave Ramsey did, which is with a bunch of real estate and business, right? You could do the same thing. Now, in real estate, typically we see at least a 10% return. Now, I could go with the same 9%. I'll go back to that in a second. But let's just say you say that same 20,000 got a 10% return. Guess what? You got $3.6 million. Now you've got about 700,000 more. Now you might say, yeah, but with inflation, Chris, it's only 1.1 million. But here's the difference. This is the big difference between the S&P and investing in mutual funds versus, and any kind of retirement plan for that matter, versus the method we talk about with this work optional blueprint, which is investing in cash flowing passive income investments. The difference is this, is that you're living on the interest. You don't live on less than the interest. I mean, you could, but they don't do that because there's always these ups and downs in the market. They want you to take out less than the interest so that when there's a down year, you don't cannibalize all your cash out of it because you're pulling out money while it's depleting. And next thing you know, you have no money left. And that's what happened. Like I showed another video with Dave Ramsey saying you pull out 8% a year. And I showed you how you can actually be broke in 15 years with just a typical market swings. That's not good. So that's why they have the 3% rule. Here, the difference is you're getting paid actual interest, real cash flow, not touching your principal. Well, that 1.15 after inflation, guess what? That's 10% of that is 111,000 a year versus 20,000. Now you might say, well, I paid taxes. Okay, say you paid tax on 111,000. Let's just say that even that 25,000 of that went to taxes. Great. Well, now you're still left with roughly about 85,000 a year versus 20,000 a year. That's still quadruple the money because you did that. Now, I'll go back to the 9%. Let's just say you got the same as the market. Doesn't matter because now you're getting now that 9% on that 91 of that 916,000, right? Even after inflation and everything. Well, then 9% of that is guess how much? Over 80,000 a year. You pay tax on it, maybe you're left with 60, 70,000 a year. Isn't that still better than 20,000 a year? This is my point. Like the whole point is this, that what got me to break free from going from stock trader and financial advisor to believing that mutual funds and the S&P 500 was the ticket to freedom, what broke me away from that is that I realized most people doing that strategy, including myself, didn't become free. When did Chris Miles and all the rest of his clients start becoming financially free? When we broke away and got away from that and stopped being chained down by that limited myopic view that that's investing. And what did we do instead? We invested, right? We actually invested in real tangible assets that produce good cash flow. Tangible assets backed by real estate, backed by business, even real business, not stocks that are fake versions of the business, right? We did real investing in things backed by commodities, things like oil and gas. Hey, we even got people that buy gold and silver, even though they may not cash flow. It's a great way to build out that wealth. That's what we did. That's what I've done. And that's what we've been doing for many years. And this is why we have so many of our clients coming back saying, hey, I've made 5,000 more a year, 10,000 more a year of passive income right now versus waiting decades from now to create that, hopefully, that same amount of income, which they may or may not be able to do. That is the key core difference. So is the S&P 500 really the safest and best place to invest? No, it's not the safest. It's been safest for the last 15 years because, again, we had that market correction. It went down to the mean to where it should have been, back to real valuations, and now it's over 200% what it should be. The Buffett indicator, by the way, says it's about 220% overvalued, more than double. Imagine if you were to just stay in the market right now and watch more than half of your money disappear in the next few years. What if that were to happen? All that hard work. I don't care if you got a 401k match or not. You also lost more than half of that too. It's gone, kaput. And then how many more years or decades even would you have to keep putting money away, slaving and saving away to get to that point? Would it now maybe be the best time? Because the smart money, by the way, the institutional money has already been moving away out of some of these stocks. They've been selling off while the dumb, ignorant money, the typical investor, the retail investor, the ones that watch Instagram and TikTok and buy their advice and think that this is true, or they watch the media and say, oh, the market's going to keep going up, you're fine. But what if it doesn't? They never give you that information, do they? They just tell you, just ride it out, you'll be fine. Well, you don't know how long you have to ride that ride. My dad rode that ride an extra 10 years into his 70s before he was finally forced in retirement, and then has been trying to live on a budget to try to make sure he doesn't run out of money. This could be you as well. In fact, this is what's happened to millions and millions of baby boomers already. And now that us Gen Xers are moving to retirement, we could be seeing the same thing. We've had 15 years of a good run. Millennials have never known a down market. They don't even know what that looks like. This is the time that people are going to wake up. And the smart people are already pulling their money out and getting it invested in other places where they actually get real income right now, not hopeful, speculation. Which, by the way, also the S&P 500, just so you're aware, people are trading on margin. People are borrowing money to put in the stock market more than they've ever done before. That alone should concern you. Massive speculation, massive debt going in the market. And when people start putting debt in the market, that's usually right before a bubble pops. That's what happened to real estate in 2006. Massive amounts of debt going in, and then it popped. Right now, we've seen more margin trading, more debt going in the stock market than ever in history. That's happening right now as we live and breathe. Are you going to be lulled into passivity, right? Are you going to just be a pacifist in the sense that you're just going to let your money ride, and then you're going to wait till maybe it bottoms out in a year or two and then you lose half your money or more? Are you going to wait for that? Or are you going to actually be proactive and do something different? Again, I can't tell you to sell off your stocks legally. I'm not going to tell you to do that. I'm just telling you, wake up. Now is the time to be awake. Those that are awake now will be, in the future, they will say, man, I wish I were you. I wish I was that smart. The ones of you that don't do that, you'll be like, oh, I was like every other American. I wish I would have gotten out. Don't live a life of regret. Live a life that makes you look smart, intelligent, and allows you to be able to make more money than you would even leaving it in the stock market, especially right now where the market returns are already exhausted. This is your time. If you want to learn more about what are those options, how can you become work optional, go to moneyripples.com, reach out to us today. In the meantime, guys, remember, you can listen to this and all philosophize and theorize all day long. At the end of the day, what's your cash flow? What's your passive income actually telling you about your financial health? That's the real measurement of your wealth. Go and make it a wonderful and prosperous week. We'll see you later.